Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Preferred stock ETFs are gaining traction with investors seeking stable income without the rollercoaster of common stocks. These funds bundle preferred shares, which offer higher dividends than bonds and lower volatility than regular equities. In this video, we'll break down how they work, their pros and cons, and the best ways to add them to your portfolio. If you're tired of chasing yields or weathering stock market swings, preferred stock ETFs might be the middle ground you've been looking for. Let's explore how they stack up. What are preferred stock ETFs? Preferred stock ETFs bundle together preferred shares from different companies, offering a mix of stock-like growth potential and bond-like income. They sit between common stocks and bonds in terms of risk and reward, making them a unique tool for income-focused investors. Unlike common stock ETFs, which track regular shares, preferred ETFs focus on securities with fixed dividends and higher claim priority during company liquidations. Think of them as a hybrid. They pay steady dividends like bonds but trade on exchanges like stocks. This blend makes them attractive for those who want income without the full volatility of the stock market or the lower returns of traditional bonds. Key characteristics of preferred stock ETFs. Preferred stock ETFs stand out because of their distinct features. Here's what sets them apart. Fixed dividends. Preferred shares pay dividends at a set rate, similar to bonds. These payments take priority over common stock dividends, so even if a company struggles, preferred shareholders get paid first. Higher claim in liquidation. If a company goes bankrupt, preferred stockholders stand before common shareholders, though still behind bondholders, when assets are divided. No voting rights. Unlike common stocks, owning preferred shares doesn't give you a say in company decisions. You're in it for the income, not control. Interest rate sensitivity. Because of their fixed payouts, preferred ETFs often move with bond markets. Rising rates can hurt their prices, while falling rates boost them. Compared to common stocks, preferreds are less volatile but miss out on unlimited upside. Compared to bonds, their payouts can be higher, but they lack the same level of protection in financial trouble. Types of preferred stock ETFs. Not all preferred ETFs are the same. The type you choose depends on your goal, whether it's steady income, rate protection, or conversion potential. Here's how they break down. Rate reset preferreds. These adjust dividends based on prevailing interest rates. Funds like the Invesco Preferred ETF PGX focus on these to hedge against rate hikes. Perpetual preferreds. These have no maturity date and pay dividends indefinitely. The iShares Preferred and Income Securities ETF PFF holds many of these. Convertible preferreds. These can be exchanged for common stock if the share price rises enough. They offer a mix of income and upside potential, seen in ETFs like the SPDR Wells Fargo Preferred Stock ETF PSK. Some ETFs also specialize in sectors like financials, since banks issue a lot of preferred stock, or focus on tax advantages, such as those exempt from federal taxes. Picking the right one depends on your portfolio needs and risk tolerance. You might not realize it, but preferred ETFs can smooth out your income stream while softening market bumps. No need to choose between stocks and bonds when you can have both traits in one fund. Benefits of investing in preferred stock ETFs. Preferred stock ETFs are a solid pick for investors who want steady income without the wild ups and downs of common stocks. They combine the best of both worlds, higher payouts than bonds and more stability than equities. Here's why they're worth considering. Higher dividend yields. Preferred stocks often pay higher dividends than common stocks and bonds. Companies must pay preferred shareholders before common stockholders, making these payouts more reliable. ETFs that hold preferred shares pass these dividends to investors, often yielding between 5% and 7%, compared to the 1 to 3% from investment-grade bonds. Why do preferreds offer better yields? Priority payments. Companies must clear preferred dividends before paying common shareholders. Fixed rates. Many preferred shares pay at a set rate, unlike common stocks where dividends can change. Less growth potential. Since preferreds don't soar like common stocks, companies compensate with higher payouts. ETFs simplify access to these yields. Instead of picking individual preferred stocks, which can be complex and illiquid, you get instant diversification across hundreds of issuers. Funds like PFF and PGX spread risk while keeping those high dividends flowing. Lower volatility and stability. Preferred stock ETFs don't bounce around like common stocks. They behave more like bonds, smoothing out returns during rough markets. Here's why. Fixed income trades. Preferred shares pay steady dividends, making them less sensitive to stock market swings. Higher claim in bankruptcy. If a company struggles, preferred shareholders get paid before common stockholders. Interest rate sensitivity. While they react to rate changes like bonds, their hybrid nature keeps them steadier than pure equities. During the 2020 market crash, for example, many preferred ETFs dropped less than half as much as the S&P 500. That stability means fewer sleepless nights, without sacrificing income. Of course, nothing's perfect. Preferred ETFs still dip when interest rates rise. But for investors tired of stomach-churning volatility, they offer a smoother ride than common stocks. Risks of preferred stock ETFs. Preferred stock ETFs might offer stability and high yields, but they aren't risk-free. Unlike common stocks, they react differently to market changes, and some downsides can catch investors off guard. Before jumping in, it's important to understand where these funds could fall short. Interest rate sensitivity. Preferred stocks act a lot like bonds when interest rates climb. Since their dividends are usually fixed, rising rates make them less attractive compared to newer issues with higher payouts. Here's what happens. Prices drop when rates rise. Just like bonds, preferred ETFs lose value as rates go up. A 1% rate hike could knock 4 to 6% off the fund's price. Longer maturities hurt more. Perpetual preferreds, those with no maturity date, take the biggest hit since their payouts stay fixed forever. Rate reset preferreds fare better. Some ETFs hold shares that adjust dividends based on rates. These help soften the blow, but they still aren't immune. If you're in a rising rate environment, preferred ETFs could underperform. But if rates fall, they could get a nice bump. Timing matters. Credit risk and issuer reliability. Preferred dividends aren't guaranteed. If a company hits financial trouble, it can suspend payments, unlike bonds, where missing payments means default. Here's what to watch for. Financial sector dominance. Over 80% of preferred stocks come from banks and insurers. If that sector struggles, your ETF could take a hit. Dividend cuts. Companies can skip preferred payouts without penalties, though they must pay them before resuming common dividends. Junk-rated issuers. Some ETFs hold lower quality preferreds for higher yields. That means more risk of payment delays or defaults. Always check the ETF's holdings. A fund heavy on shaky banks or unrated issuers might promise great yields but come with hidden dangers. Look for funds with a mix of investment-grade issuers to balance risk. Stay tuned for part 2. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.